Okay, itemized deductions. Work should be over now because most of what's left for itemized deductions you are doing and learning as you do the tax returns. So remember, you always get the larger of the standard or your itemized. So we're going to talk a little bit very briefly about medical and taxes. You really don't need to listen if you're comfortable with what you've been reading. I don't have a whole lot to add to what is in the Pub 17 and your instructions for your Form 1040. So I'll just highlight a couple of things as we work through these slides. Remember, this is not an all-encompassing presentation. It's just a couple of highlights to supplement what you've already learned. So I guess before we do that, we just have a couple of slides that repeat the standard deduction for 2013 and for 2014. Remember, this number is indexed for inflation, tends to change every year. If you're calculating the alternative minimum taxable income, you do not get your standard deduction or your exemptions. And of course, there's also the bump for age and blindness. The amounts are here. Remember that if I bold someone's age or say they are legally blind, I will tend to prompt you with some bolding. Pay attention. This only applies to the taxpayer and spouse, not to dependents. And just those are the two categories, right? Blind or over 65. And there could be up to 4 add-ons for a married filing joint return. Medical expenses. Qualified expenses. So if I tell you the qualified expenses were X, what is line 4? I'm simply asking you to do the math. Alternatively, if I list expenses and I say which of these are qualified to put on line 1 of the Schedule A, that is a slightly different question. So make sure that you're answering the question you're being asked. So yourself, your spouse, your dependents, or someone who would be your dependent, except they had too much gross income. And so you got to be careful when you're reading the IRS materials. It refers to a dependent is using different definitions in different areas. What they mean by a dependent when they talk about exemptions is not exactly what they mean when they talk about a dependent for the purpose of the earned income credit, not exactly what they mean by a dependent for the medical. So the short story here is your kid's living with you. He's 26, gone back to school, making $8,000. You cannot claim him as a qualifying child or a qualifying relative. So he is not your dependent for the exemption purposes. But if he ends up getting really sick and you end up paying his medical expenses, he is a qualifying person for you to claim his medical expenses. So reading is all in the fine print. So never assume that you know what a word means. Take it to the context in which we're discussing it and see what the IRS has in place for you for torture for the day. Qualified medical expenses, I strongly suggest that you look in the Pub 17. They've got a list of everything that does count on one side of a chart and everything that doesn't count on the other side of the chart. Medicine must be prescription with the exception of insulin. Insulin is so commonly needed that it's no longer required to have a prescription to get it. Quit smoking or weight loss cannot be over the counter. Would have to be the right prescription for the right person. Not cosmetic surgery. So it makes a difference whether you just don't like your nose or you forgot to wear your seatbelt and your head smashed into the windshield and now you're having to have your nose reconstructed. The reconstruction because of the accident would be deductible, even if they land up taking just a little bit off the top because you always thought it was too long. This deliberately having surgery to just adjust a perfectly working nose is cosmetic and there's no tax deduction. And then capital expenditures, you have to have a prescription, the short story, and it cannot be, the deduction cannot be more for the increase in your fair market value. So one of our RQs is going to have you guys looking at different scenarios to decide whether or not something is a qualified expense for medical. Not every swimming pool creates a tax deduction for medical. Generally, you have to have the right kind of illness where the only exercise that will suffice is swimming, and there's some reason or other why the public pools don't suffice. And then if you spend $10,000 for the pool, it increases the value of your house by $6,000. You could only deduct $2,000, even if you did get the doctor to sign the prescription form for you. And then institutionalized care, nursing homes, only if medical care is the primary purpose. So if your aged mom is really driving you crazy and you ship her off to a nursing home, you cannot take a medical deduction for this. It will be a personal non-deductible expenditure unless she has a really bad heart and needs round-the-clock supervision. If all she needs is an insulin shot once a day, putting her in a nursing home to ensure she gets the insulin shot will probably not get you the deduction. Special schools for the blind, etc., are an exception. Even though you're sending your kid away because he's on your nerves, if he happens to be blind and you send him to a school for the blind, you do get a medical deduction. Once again, the special facilities, right? If you send him to a general boarding school, you're not going to get a deduction. You have to send him where he can get the kind of care that he needs. And in the mileage rates, 24 cents this year. We've had some actual compression. Some of the rates are going down in 2014 because the price of gas has gone down a little bit. Changes every year. The rate is different when it's business use of your automobile, when it is driving for medical or moving, or charitable. Remember, charitable was only 14 cents. And then we reduce first by any insurance proceeds, and then the 10% of AGI in order to get to that line 4 amount. Reimbursements of medical costs are not income. There is a little trick here that we'll stay away from. When you get a reimbursement, sometimes it isn't till the next year. Not for most of us, right? If you have a nice, simple, all you do is pay copays, then you usually don't have this rule. But it would be possible for you to have one of those high deductible plans where you have to pay everything out of pocket. And then once you reach a certain level, you can apply for the insurance to kick in. And sometimes that paperwork can take a long time. So if you took a $5,000 medical deduction in 2013 and you got $3,000 back in 2014 relating to that deduction, you would have to include it in income and down at that other income line. Does not happen very often. I will not give you a test question on it. Income taxes, the short story here is all income taxes are deductible except your U.S. federal. Remember, your federal withholding is a payment. It goes on the back of the 1040 as a payment. Your state taxes withheld on your federal return are a deduction on your Schedule A. Foreign taxes, we're not going to go there. You could take a deduction. Generally, this foreign tax credit option is better. When we have our graduate level international class, there's 3 or 4 weeks dedicated to tax credits, foreign tax credits, so we're not going there at all. 4 or 5 states do not actually have an income tax, and you can imagine if there is no income tax, your sales taxes are probably higher because the money has to come from somewhere, right? And a few years ago, when the government was running some surpluses, the politicians from those states managed to convince the government to add the option of either deducting your state taxes, income taxes, or use the sales tax deduction. Because of the way that bills get marked up, to have made this a permanent change in the tax law would have been too expensive, because every time there's a change in the tax law, the Congressional Budget Office has to run the numbers, and it tells Congress what they're saving or spending, and they have to match that with something else. You have to cut taxes somewhere else. You have to raise taxes somewhere else, but they can't just make changes unless state of war, those types of things, without running through at least an attempt to balance everything out. So this is one of what they call extenders, which means that every year the Congress has to decide whether they're going to extend it for another year, and they go through the Mickey Mouse of trying to figure out how to cover these things. But they've been extending it now for a better part of 10 years, so my guess is they'll continue to figure out ways to do it. So the math is pretty complicated. Used to, when we had the take-home tests, this would be a question I would throw you into the deep end and make you struggle on all by yourself. We clearly don't have time for those kinds of things in the new format. So see, life could be worse. So let's just talk about this a little bit. The instructions for this are in your Schedule A Form 1040 instructions. I may refer you there for a quick in and out true-false question, so don't go to sleep. All right, so choice of deducting the income taxes or the sales taxes. There is a tax table that will tell you if nothing peculiar is happening. It will tell you what a family of 4 living in state X with a adjusted AGI of Y should have spent on taxes, and you can use that number. So it's just a quick lookup for most people. But if you have any of the things listed here, you would get to add the additional taxes. But note that second bullet says the general tax rate. So if for some reason your state charged 4% for the normal sales tax, but 5% on motor vehicles, then you could only deduct the 4%. You would not get to deduct what you actually paid if the state is charging more for those kinds of things than it does for the groceries and the clothes and things. And there is the IRS publication, but there's also in your instructions for Schedule A. I would strongly suggest, as I said earlier, that you bring your instructions for the Form 1040 to class. If you got your Schedule A instructions separately, then bring both pieces. But if you got one fat book, it'll have everything together, because you may need to get in there to look something up, and you don't want to have to waste any more time than you have to. The second category of taxes that are deductible are property taxes that are ad valorem, or on the value. The primary example of this is your real estate taxes. The assessor simply tells you what your house is worth and assesses it at 2, 3, 4, 8 cents per $1,000 and sends you a bill. It's important to remember that there could be some complications with real estate, because most people tend to pay it in annual or at least 6-month installments. And so it could be possible that you paid for a full year, but you did not live in the house the whole year. And there will be some adjustments at closing on the sale of the house. So we don't have those fancy mechanisms. So just remember that if you only own the house for 6 months, you only get half of the real estate taxes, even if you paid 100%, right? You don't get a deduction for something that's not your responsibility. The other version will be property taxes assessed on cars and boats, as long as they're assessed on the value. So when you license your car, you give them $20 for the county. That's a flat fee, because everybody gives the same $20. That is not a tax. It is not deductible. So it's only the portion of your renewal that's based on the value of your automobile. Remember, property taxes are not the same as sales taxes. Sales taxes are assessed on the privilege of acquiring something. No tax deduction unless you're taking the sales taxes as larger than your state income taxes. Property taxes, you've already purchased it, and you're continuing to pay taxes for the privilege of continued ownership. So make sure you read the fine print as usual. And be careful about, sometimes real estate taxes have an assessment for sidewalks or something. That's an improvement. That's not a tax. Only the portion based on the value of your property creates a tax deduction. So there's not much left on our laundry list. We are not doing casualty and theft losses now. It'll be on the very end of the semester. So miscellaneous itemized deductions, they come in the 2 categories. The one we've been seeing, subject to the 2% of AGI reduction. And the other category, your gambling losses, your work-related impairment costs, those are not reduced by 2%. I would never memorize anything here. Remember, our friendly IRS in Pub 17 has got a whole chapter dedicated to this topic, and charts and laundry lists of things that are meeting the requirements for deductions. The short story is you're looking for things that are ordinary, necessary, and reasonable for a allocation of something that relates to production of income or trade or business expense. Just a reminder that we're not doing them. You will see nothing about casualty and theft losses until later in the course. There are two broad categories of miscellaneous 2% itemized deductions. First, employee business expenses. You fill out the 2106 or the 2106EZ. And then all Section 212 expenses except rents and royalties. They are deducted for AGI on Schedule E. And then don't forget that you're going to reduce by 2% of AGI. And then just a couple of comments about employee business expenses. Being an employee is a trade or business. So the Internal Revenue Code does not say you're a doctor or lawyer or an Indian chief. It says you simply are an employee. And when you incur expenses related to being an employee, you can take a deduction. You have to be careful here to distinguish between personal and trade or business expenses. We talked earlier about the difference between commuting and transportation. So you need to have good records in order to defend yourself should your tax return be audited. And then just a reminder, if you are reimbursed and you account to your employer, you bring him the receipts, you bring him your mileage from your car, then you do not have an income event. It is your employer who's taking the deduction and doing all of the reductions related to entertainment and travel. And all you do is turn over your receipts and move on. The rest of the slides in this area are just me going through some math to make sure you understand how it works. If you are comfortable using your spreadsheets and your tax forms, you may not need this information. You may want to just run through the examples without the narration on if you think that would be faster. Just make sure you know how to do the math. Remember that I will always give you the checkbook figures, and you're going to give me the final answer, please. So here's an example of things that would be treated as miscellaneous 2% deductions. And all of them are checkbook figures. So you'll notice there's some business entertainment. In an example like this, if I just say qualified or valid business entertainment, I've already done all of the due diligence that we talked about in Chapter 6, but it is still a 100% checkbook number. And so you'll have to apply the 50% rule before you do anything else. So calculate your final deduction given two different AGI offsets. One, if you are making AGI of $100,000, the second, $500,000. So first thing we do is we reduce entertainment, and then that will get us down to $13,650. But you'll notice that one of the earlier bullets said our final answer is $2,000 less than that. And that should not surprise you because 2% of $100,000 is $2,000. And that's how we get to that number. So our final deduction is $11,650. If we were married filing joint, we'd use the standard deduction. Everybody else would go ahead and itemize because $11,650 is larger than their other option. The second example is a little sadder deduction-wise, but I would certainly rather have that $500,000 of AGI. So my final deduction is significantly smaller than on the other slide because my 2% of AGI offset is so much larger. This time 2% of AGI is $10,000, and so $10,000 is the amount by which I need to reduce my deduction. So now everybody would use the standard deduction unless they had other itemized deductions. These slides are going to conclude with several different kinds of examples of reductions and deductions, including the 3% rule. So remember that when you're done with each individual category, you have to apply that 3% rule to reduce them even further if your AGI is over those thresholds that we talked about in earlier slides. So the 3%, only certain items are subject to it. And what I've shown here are the ones that are not. Medical has its own offset, 7.5%. Casualties, when we get there, are offset by 10% of AGI. Investment interest expense, you will remember from our last set of slides, you cannot deduct any more investment interest expense than you have net investment income. And not now, but in a few weeks, we're going to learn that your gambling losses are limited to your gambling income. So each of these reductions can be fairly substantial. So when they wrote this rule, they decided that they would not reduce these individual items any further. So make sure that you know these four do not fall prey of the 3% rule. Everything else on the Schedule A does. So the steps, first of all, you need to know your thresholds, or at least look them up. When people are making more than $200,000, you should think, oh, I better double check, rather than memorize anything. Know which deductions get reduced, everything other than the 4 on the prior slide, and know how to do the calculation. So you can use the worksheet or you can follow the examples here. And once again, if you are comfortable that you know how to do this math, you certainly would be free to move on. But don't get overconfident, because the math does require you to go step by step. And if you skip a step, you can end up with the wrong answer. So one thing about the 3% reduction is it never does reduce to 0. Remember the exemptions? Thelma was so rich that she landed up with 0 exemptions. That'll be the same story on tax return 7. But her itemized deductions, first of all, we've got the 4 that don't get reduced by the 3% rule. And then, of course, you always have the potential of your standard deduction. So you get the larger of the limited minus the 3% rule, plus the 4 that are not limited. Or you get 20% of the limiteds. So your mortgage interest will never get reduced to less than 20%. So if your mortgage interest was $10,000 and your AGI was $1 billion, your 3% rule would still leave you with 20% of the $10,000, or a $2,000 mortgage interest deduction, because they individually do not go down to 0 the way they do with the itemized deduction, with the exemptions. And don't forget that good old standard deduction is there as our backup. So your threshold, remember, depends on filing status. So we produce all the other limits first. So do your regular Schedule A column, category by category, before you worry about the 3% rule. If I give you entertainment, meals, reduced by 50%, reduce medical by 10% if you're young and strapping, 7.5% if old, reduce miscellaneous by 2%. If we were doing casualties, you would reduce by 10% of AGI. So now we have an example. AGI is $375,000. Married filing joint, both age 45, which tells you that the medical offset is 10%, and that there will be no AMT adjustment for medical because they've already had the 10% reduction on the regular tax calculation. So mortgage interest is reduced by the 3% rule, but it's not reduced by anything else. When you get to a problem like this, you can be sure that I'm not talking about a mortgage that's more than $1 million. So this would be the qualifying mortgage interest deduction that someone who was below the threshold would get in full, that you're now having to use the 3% rule. So remember, in this case, we don't have any of the other limits, but you would apply them first before the 3% rule. All right, so AGI, the threshold for married filing joint, the math, 3% is 2250. So you will reduce the 20. So after your reduction, you're going to pick one of the 3 following items. $17,500, which is the original $20,000 minus the 3% excess. 20% of the $20,000, which is $4,000, or the standard deduction. So in this case, the taxpayers will take the itemized deduction of $17,500. In our second example, our taxpayer is also really relatively well-to-do, this time single, 45 years old. His only deduction is qualified medical expenses of $40,000. So we want to run through the base limitations first before we worry about anything else in our determination. So if we go down the laundry list, this is medical. It's either reduced by 10 or 7.5%. Go back and check his age. He's a young one, so you're going to reduce by 10% of AGI. So the 275 not reduced by anything because it's all the entire AGI is used for this calculation. Reduced by 10%. So he's going to lose 27,500. He started out with 40, and so he's now down to 12,500. And when you think about the 3% rule, you can go, oh no, medical's one of the 4 that aren't reduced. Since there was no 3% reduction on medical, this time all we have to do is compare the final line 4 on Schedule A amount for medical to the standard deduction, which for a single filer is only $6,100 in 2013. So the final answer is $12,500. All right, in this third example, we have head of household as our filing status, age 72 bolded, which tells me there may be some medical expenses coming up. And indeed there are. Because he's over age 64, you're going to only use 7.5% to reduce the medical. He also has mortgage interest. And so now 2 itemized deductions. The math is different for both. And so you got to keep all your little ducks in a row as you work through this. So the deduction for medical is just the 7.5%. Only the mortgage is reduced by the 3% rule. So before you start any of these problems that ask you to do these calculations, you really need to get organized and focus. What reductions, if any, do apply? Work your way through them systematically, and then don't forget to compare to the standard deduction. So the first step is to reduce the medical by either 7.5% or 10%, depending on age. We already decided that this is an old geezer, so we're going to use 7.5% for that reduction, or 22,500. So he started out with 28,000, and he's down to 5,500. If this was the only item in play, we would stop here and take the standard deduction for head of household. But now we need to add to this as much of the mortgage as survives the 3% rule. So if you want to think of this problem as we're doing both the first example and the second example, we have to run through the medical from soup to nuts and then stop and go back to the mortgage interest, run through it soup to nuts, and then we're going to add them together and compare the combined number to the standard deduction. All right, so here's an AGI threshold for a head of household. The first math, multiplying by 3%, is the second math. So this isn't a very big reduction here, only $750. All right, so then we got to compare the 3 limits. You get the largest of what is left of the mortgage plus the medical left untouched after the 7.5% reduction, and that's $24,750. Or 80%, or I'm sorry, 20% of the mortgage, because it can never be reduced more than 20%, plus the medical, untouched from our original calculation, or the standard deduction. And in this case, clearly the itemized after all our reductions went out, and our final answer will be $24,750. Our last example. AGI single, age 32, business entertainment. All right, that's the checkbook figure. So your little calculator finger should be twitching because you got lots of work to do with that number. So what is our final deduction from AGI? All right, entertainment reduced by 50 cents on the dollar. Apply the 2% rule. Apply the 3% of excess AGI rule to get the final answer, please, which you would then compare to the standard deduction to get the real final answer. All right, so reduced by 50%, so we're down to 12,750. Reduced by 2% of AGI, and 2% of the whole AGI not reduced by any thresholds. And now we're down to $7,050. And then we need to apply the 3% rule. But you can see at this point, you're pretty sure this person's going to itemize, right? Or take the standard deduction. Because once we reduce this some more, our standard deduction is $6,100. So we're going to be down to the standard deduction. But let's do the math. AGI, threshold, excess, 3%, gives us $1,050. So now we're going to compare our three limits. And the taxpayer gets the largest of what is left of the entertainment, reduced by the excess 3% rule, or $6,000, or 20% of what was left after the 50% and 2% reductions, or the standard deduction of $6,100. So as I predicted earlier, the standard deduction wins. That will be the deduction that the person takes. All right, this is our last slide in this area. You can see that it's not so much memorizing, because you can look up things that are deductible, whether they are medical or insurance or whatever. What is going to be the complicated part is keeping all the math straight. The IRS worksheet can be very helpful if you get comfortable with it, or find one of these PowerPoint slides and run your math next to my example of that math. Either way, you need to be careful and accurate, or you will not have the right answer. I will not be combining, is this a medical deduction, with what is the final answer on itemized or standard. Those are two separate questions. So when I ask you to do the math, concentrate on doing the math carefully. When I ask you to identify whether or not something is a qualified deduction, look at the facts and see where it fits in the grand scheme of things. See you in class.